Hi, I'm Martin McGrath from Financial Edge Group. Today I want to talk to you about a little bit of a hidden death tax that a lot of people don't know about. Death taxes in Australia aren't really a thing. There's no taxes you've got to pay typically upon your death. There might be some tax on whatever assets you're passing on, depending upon the investment properties or shares, and one of the things I want to talk about today is super. A lot of people don't know, but under the bonnet of super, there's potentially an outstanding tax liability. And what that comes down to, I'm going to get a little bit technical because I need to explain this, but also good news, I've got some solutions to help solve it. So super's great. We help clients get as much money as super as possible. The reason is that once you're retired in Australia, over the age of 60 or 65, the money you've got inside of super, you're not paying any tax on. No tax on the earnings, no capital gains tax, no tax when you take it out, whether that's monthly or annually, however you like. So our goal is to help clients get as much money in as possible. And the goal of super is to spend that during your lifetime. But in a lot of cases, there's some assets still there, that the investments are set up so well that it's covering our living costs, but the capital is not really being eaten into. It's going to stay there for many years and pass on to the next generation. Now, we do a lot of work with clients at various stages of this journey, but also potentially later in life, and that's where this discussion is relevant, is that underneath the bonnet of your super, you have what are called components, taxable components and tax-free components. And the name's a bit of a hint there. The tax-free components, they're tax-free. The taxable components have a bit of tax. Now, for the person who's receiving this pension, there's no tax to them. I'm talking about tax when it goes to the next generation. Typically between spouses, that's fine. There's no tax event. But if there's money left over going to adult children, then there potentially can be in some tax. That tax is somewhere typically between 15 and 17%, depending on how your estate's set up. And that might not sound too bad, but on large balances, that can be pretty significant. So we met with a client last week who we're having this discussion with. They're in their mid-80s, early to mid-80s, and overall they're pretty healthy. But they're at a stage of life where there's less years ahead of them than there are behind. And they've got a comfortable balance inside of super. And we had this chat around that while they're alive, it makes sense to keep as much money in there. But they have this taxable component inside of their super fund. 3 adult children in their 40s and 50s that the money's going to be passed on to. And that quantifies, that value is about 130, 140,000 in tax that may need to be paid if that person was to pass away. So that's a fair bit of tax. Now, the balancing act is, while the money's in there, we're paying no tax. And we figured out that it makes sense to, for so many years, keep the money in there, depending on where we move that money out to. There's a few different ways to solve this problem. So it makes sense to keep it in there for as long as possible, but if we know we're going to die, often we want to get it out there before then. So how do we plan for that appropriately? One is, you take the money out when you know you've got only days or weeks left to live. That might sound nice, but practically probably pretty hard to plan for. So we need to be proactive with this stuff. One of the things we do for clients is that we start to sit down and look at some figures. Can we take this money out and just put it all in cash? That will save this tax. Do we take the money out, keep the investments the same, and put it in our personal name? Or do we take the money out, keep it invested, and put it into a different structure that has a cap on tax? Now, this client's balance is large and they like investments. The cash option, not on the table. And potentially they've still got many years left to live themselves, maybe all medicals to pay for, maybe some aged care to pay for. So we agree that cash is not on the table here. I think if someone only had months to live, that would potentially be the appropriate response. Therefore, we're looking at one of the two other options. If we move the investments into their personal name, we calculated that they would pay about 20 to 25 grand a year in tax by investing in their own name. Now remember, this 80-year-old's paying no tax. So to move it out to potentially pay 25 grand a year in tax is a big expense. But by doing that, we're saving the kids paying 130 or 140,000. So it's then the question, well, how many years am I going to live for? What does that look like? What we're likely going to pursue is option 3, looking at an investment bond structure where we can move that money out into a super fund or into an investment structure with a tax cap. Investment bonds, we've done separate videos of them, so I won't do a complete deep dive now. But one of the best things about them is that you can still maintain a lot of the investments. It's not at a personal tax rate. You have to pay personal tax and lodge tax returns. they're an internally taxed structure. Somewhere between typically 10 to 30% in tax, and depending on how you got it set up with certain franking credits, typically most of them are between 10 and 20, and potentially about 10 to 15% in tax you've got to pay. We figured out that we can move this client's investments into there, and they may pay about 8 to 10 grand a year in tax. But we lock away the savings of the kids having to pay any tax. When we move the money into that structure, they might pay 8 or 10 grand a year in tax, don't have to do tax returns, and we're saving the kids 140 grand. And when it comes out of that structure to the kids down the track, no tax at all. So we're locking that money up. And assuming this client's got less than 16 years to live, then they're going to be better off by doing that sooner rather than later. So it's important to plan for this. I wouldn't rush out and worry about this in my 50s or 60s and potentially even 70s. But if we've got some ill health, if we're getting later in life, it's important to start to plan for this stuff. If you want to have a chat about your circumstances, feel free to reach out to us at Financial Edge Group to find out a bit more. Everyone's numbers are different, everyone's components are different, and your circumstances and family structure is different. So it's important to have a chat about this rather than rushing out and do anything. But it's also important to be proactive with this planning, and that's what we're here to help with.